Big news overnight. Global bond market jitters continue with long end bond yields surging to all time highs all around the world. As here in the US, there's a massive shakeup at the Fed as Trump fires Fed Governor Lisa Cook. Consumer confidence also dipped amid rising inflation fears. Home prices are cooling fast, with real estate wealth starting to erode, and durable good orders tanked again, signaling manufacturing woes. So, before we get to the major moves in the sovereign bond market all around the world, as well as how markets are responding to Trump's major move to fire Fed Governor Lisa Cook, we're going to take a look at a couple reports that were released this morning. The first is durable goods orders. On a month over month rate of change, they decreased by 2.9%. Here's another 2.8%, excuse me. Here's another way of visualizing that data. On a nominal basis, they look quite strong. Durable good orders look great. However, once you adjust for inflation, we can see that going back to the 1990s, for the past 30 years, durable good orders have actually been declining on an inflation adjusted basis. I will link to this in the description, but I highlighted a few key areas that I think are important to point out. Here we can see shipments and new orders on a year over year rate of change are up 2.5 and 7.3% respectively. However, after excluding transportation, which includes aircrafts and Boeing, they are only up 1.5 and 1.9% respectively. We can see a significant move in computers and related products there, 14.3% increase in shipments and 13% increase in new orders. Here is that non-defense aircraft and the Boeing story. We can see shipments are up 34% and new orders are up 139%. Boeing is being used by President Trump in some of the tariff and trade negotiations. He has been able to secure quite a number of orders, new orders, for companies like Boeing, clearly an American company that makes aircraft. So Zero Hedge notes that core durable goods rise at the fastest annual rate in 3 years. Here, we also got some home data. So again, I will link the report here for the S&P Case-Shiller home report that we got this morning. In white, we're looking at the price index, the overall price as measured by S&P Case-Shiller of home prices. And we can see it is up and to the right going back the past 25 years. However, the year-over-year rate of change is decelerating notably. And this data is not 100% current. This is the last month's data. We'll take a look at the report with the graphs that are 100% current. But the trend here is what is important. So we can see a notable deceleration in home prices. Home prices are still going up and to the right. They are just going up less slowly. So this kind of fits into the broader CPI disinflationary trend that we have, where the things are still getting more expensive. They are just getting more expensive at a slower rate. So here is another way to measure the average sales price of a U.S. house in purple. And again, it's the same story. We can see it's up and to the right. And then here is yet another way to measure the average single family home price. And again, it is up and to the right. So home prices are not crashing. They are just going up at a slower rate. So here we will look at the S&P Case-Shiller report, highlighted a couple key areas. We can see the national index continues to display growth, meaning home prices are going up at 1.9% on a national basis. However, wealth is eroding in real terms. So inflation adjusted, your returns are actually starting to go negative, with home price gains 1.9%, trailing consumer inflation of 2.7%. So I've long said that I don't believe national averages for single-family homes will crash. I've been saying that since 2022 and has proven correct. What I would say with that, with a caveat on that, is that I've always felt like in real terms, we might see flat to even slightly negative returns in, say, gold terms or in Bitcoin terms, or even using CPI as a deflator, as a denominator. And so I think that caveat is important. However, in nominal US dollar terms, as we just saw, home prices are going up and to the right, and that is more a dollar story than it is anything. And they note for the first time in many years, home prices are failing to keep with broader inflation. This trend could definitely continue. I've not heard anyone really making the claim that home prices are going to crash in real terms. They always say in US dollar terms. In real terms and gold terms, absolutely, you could see an erosion of real inflation adjusted housing returns. But in nominal US dollar terms, when core CPI is running at 3.1%, we have a 7% pro cyclical fiscal deficit. We're talking about negative 300 basis points of real rates and shifting all of our debt into treasury bills, those sorts of things. I don't see how you get a nominal US dollar decline nationwide in home prices, let alone a significant one. Here we can see that they reported a 1.9% annual gain. This is down, so the rate of increase is slowing. This shows New York. Here is the national average. Again, home prices are still going up, they're just going up less quickly. Here are those home prices in a couple different ways of measuring it: national, composite, 20 city, and then composite 10 city. And again, the trend going back to the 80s is just up and to the right in a parabolic looking uptrend. So that is what is important. If you are calling for this to crash in nominal US dollar terms, I think you need more evidence. And maybe someone in the comments can point me to the evidence that home prices are going to crash in nominal US dollar terms. In real terms is a different story. And we might be starting to see a trend change in real terms, in inflation terms, in gold terms. But in nominal US dollar terms, I still think is very unlikely. So here are a couple metro areas with outsized moves: Chicago up 6%, New York up 7%. On the other side, San Francisco and Tampa both noted significant declines, 1.9% and 2.3%, respectively. However, again, on a national basis, when I talk about home prices and where I think they are going, I'm talking about national averages. National average is still up 1.9%. So we also got consumer confidence report, which I will link in the description as well. A couple key points. Consumer confidence fell from last month by 1.3 points. The present situation index also fell by 1.6 points. The future expectation index also fell. This is the short term outlook for income, business, and labor market conditions. This also fell. Among demographic groups, I thought this was interesting. Confidence fell for consumers under 35, but was stable for boomers, actually rose for baby boomers. Those over 55, Gen X, stayed constant. But again, that youth unaffordability story that we've been talking about breathlessly, this continues to show up in the data. We can see that confidence is falling the most for the youth. By partisan affiliation, confidence weakened in August for both Republicans and Democrats, but was little changed for independents, which is kind of interesting. So here we can see that consumer confidence index. It has been in a downtrend going all the way back to 2019. This I thought was interesting. So consumers are getting more bearish on stock prices and more bullish on interest rates. Here, that present situation index, again, this is the assessment of current business conditions. This improved slightly in August. 22% of consumers said business conditions were good. This is up ever so slightly from 20.5%. 14.2% said business conditions were bad. This is also up from 13.6%. So you have an increase in those saying conditions are good and an increase in those saying that conditions are bad. Consumers' view of the labor market also is cooling. 29.7% of consumers said jobs were plentiful. This is down from 29.9% last month. And the share of consumers saying jobs are hard to get, this is increasing. This is increasing more notably, up from 18.9 to 20%. Here is that present situation relative to future expectations. Again, more bearishness on the labor market, more uncertainty with the labor market. The consumer assessment of the family current financial situation were slightly more positive in August, but as we can see with this data, continues to show a wide differential or wide delta between those that are saying their family's current financial situation is good relative to those saying that their current financial situation is bad. So again, that K-shaped economy, consumer assessment of their family's expected financial situation, so into the future, again showing a notable K-shape and a wide delta between those saying better relative to those saying worse off. So that K-shaped economy, very, very, very much at play. And finally here, consumer perceived likelihood of a U.S. recession over the next 12 months rose in August. And we can see that there. This is now, if this is a K shaped economy story, remember the top 10% account for 50% of consumer spending. So we have the K shaped economy. So how the bottom 50, 60, 70% of consumers are feeling, unfortunately, for aggregate US data doesn't really matter. But if you look at if you look under the surface, this expectations data that we were going through at the beginning remain below the threshold of 80 that typically signals a recession is ahead. So anything below 80 signals that, generally speaking, that a recession is ahead. And if we go down to that data here, we can see that yellow line or that orange line for the expectations index, and we can see that expectations have been hanging around that 80 level. Again, a recession is pretty unlikely given that it would drive the deficit to 15 or 20% of GDP. So here we're looking at the financial market reaction to the big news overnight: Trump firing Fed Governor Lisa Cook. Bond yields were rising. The 30-year here was approaching 5% again, currently at 4.92. We'll get to the global bond market situation. Equities had dipped overnight. Futures had dipped significantly on the news. As the news was released, S&P 500 futures sold off by about 0.4%. We can see volatility, or the VIX, did gap up kind of overnight as this news was being reported. However, it has come in. So the market is not responding in a significant way. You did have bond yields moving higher, not in an unruly sort of way, but bond yields at the 10 and the 30 were up about 4 to 5 basis points, but they are reversing a lot of that. And if we look at equities, equities are about to go green on the day. So the markets are shrugging this off. Now, you do have a move in the dollar, move down in the dollar. This would be expected with a loss of Fed independence, but seems like maybe a lot of this sort of tension between the Trump administration and the Fed is already priced in. So a lot of people were sharing a particular chart showing like the 30-second time frame of the DXY dollar index, and it was just vertical straight down. It's important to zoom out. Yes, the dollar did make a sharp move lower as that news was being released, rightfully so. The dollar you would expect to sell off, but it's always important when you see those to try to get perspective. Here's the perspective. The dollar index is still hanging around kind of in this range that we have been in going back to early August. So globally, there are some big moves in kind of global rates that should be addressed because there was some major news out of France. So this ratings agency here says that the political impasse undermines the planned budget deficit reduction. We've done videos on Italy and the UK. We have not done one on France yet. Maybe it is time to do that. But the West, broadly speaking, the developed West, broadly speaking, it is not just the US that is in debt and fiscal issues. It is happening in France, is happening even more pronounced in the UK, is happening across the West. This is not just a US story. We can see that this ratings agency says that a collapse is the most likely outcome and would obviously be negative for French bond yields. So French bond yields higher, bond value down. Remember, when we're looking at bond yields, they are inverse to the value of the bond. So long-term government bonds, we're looking at 30-year duration, 30-year maturity. The value of these sovereign 30-year notes has been declining significantly. This chart goes back to 2020, late 2020, and we can see that it is not just the case in the US, which is represented here in white. It is the case for France, Germany, Italy, Great Britain, Japan, and finally, here is China. So Chinese yields are actually, I had missed this, but Chinese yields look like they have bottomed and look like now clearly China had very, very poor growth for the past couple of years, really. And it looks like Chinese yields might be starting to bounce, indicating higher nominal growth expectations for the future. So here we're looking at yield not inverted bond price. So yield. And we can see that the 30-year bond for China was yielding down here at the low 1.86%. It is up to 2%. So that is a significant move. Now we'll need to wait and see if there's follow through. It is still in a very long-term downtrend here. But if this continues, if China starts to reaccelerate, that could be positive in terms of kind of global reacceleration of nominal growth, which I've had the view, at least going back to May ish, that the US would start to see a curling up, a reacceleration in nominal growth, both in inflation and in real inflation adjusted growth. So far, the data is starting to kind of indicate that that reacceleration might be starting. Remember, China plays a huge role in the global economy. So watching Chinese yields will be important. So we covered that rating agency for France, noting that a collapse of the French government seems the most likely. This would be negative for yields, or excuse me, negative for bond values, yields higher. Remember, inverse to the value of the bond. I also wanted to point out Japan. So in green, we're looking at the Japanese 30-year, and I will take off some of these others so it's easier to see. But Japanese 30-year notes, bonds, the yield closed at the highest weekly close on record, going all the way back as far back as I have data for. We can see that the 30-year Japanese JGB is yielding about 3.22%. This is the highest going all the way back to 2005. Now, we have done a lot of videos on Japan, and really the story with Japan is one of reaccelerating nominal growth. Remember, long end of the yield curve does not behave based on what the central bank is doing. It is behaving, pricing in the future expectations for nominal growth. Nominal growth includes inflation plus real inflation adjusted growth. And Japan has seen a reacceleration. They are coming out of their lost decades, very, very poor growth, high unemployment, anemic growth, even deflation where prices are going down. They've started to come out of that lost decades. And this goes back years, 2, 3 years. They started to have wage growth pick up, inflation started to pick up, real growth started to pick up. So you would expect Japanese yields to start climbing. Now, the important point here is that Japanese net international investment position and what these higher rates, why they matter. Now, I would push back on those that are claiming that Japanese 30-year bond yield is surging and the bond market is imploding. We're not seeing a weakness in the Japanese yen, especially a significant weakness that you would expect to see in much more of a crisis sort of situation. Now, it's possible that we start to see that in the future, but so far we do not see a significant weakness in the yen. So bond yields climbing. Remember, if nominal growth is accelerating, if your economy on a nominal basis is starting to reaccelerate and heat up, you would expect higher bond yields. And it's not necessarily a bad thing. We have just been kind of conditioned in the past 20 years of having very anemic growth, this kind of silent depression that I talk about. We have been conditioned to think that interest rates should be, 50 basis points, 1% for a 7-year car loan or whatever. But this is not the normal state of affairs. Bond yields should be higher. Growth should be higher. So if you're getting higher nominal growth, that does not make this higher bond yield, this highest on record for the 30-year, does not make it a bad thing. What could be an issue, Japan has run current account surpluses. They have run trade surpluses for many, many decades, very, very large current account surpluses. What that means is that on a national level, they are accumulating national savings. They sell more goods to the rest of the world than they buy from the rest of the world. So they are selling more goods than they are buying. They're exporting more than they are importing. What that means is that wealth is flowing into their country. Well, some of that gets stored, of course, in foreign exchange reserves. Some of it gets stored in real estate. Some of it gets stored in equities, right? The NASDAQ and the S&P 500. Some of it gets stored, of course, in U.S. Treasury. So what happens if you look on a net international investment position, which is the difference between what a country owns of the rest of the world's assets versus what does the rest of the world own of their assets, that the difference between those two numbers is called the NIP, the net international investment position. Japan's NIP is 75% of GDP. I think it is only second to Taiwan, which is, I think, 110% of GDP. If you look at the US, Ours is negative 95% of GDP. It is the lowest that I've seen in world history, that I'm aware of, at least. What this means is that the Japanese have accumulated trillions of dollars of national savings from running current account surpluses for many, many decades, and some of those savings are in U.S. Treasuries. So what happens when, for 2 decades, Japanese government bonds did not yield hardly anything. They had yield curve control, QE, so on and so forth, at very, very, very low rates. What happens, though, when the yield on a Japanese government bond starts to increase? Now, right now, we have the 30-year maturity yielding 3.2%. Just if you go back to, say, 2019, it was yielding 0.2%. So there is a yield at which Japanese that might have some US treasuries and therefore dollar exposure, they're in the dollar, which, by the way, is down 11, 12% on a year to date basis. They are exposed to the dollar. They own US treasuries because they've accumulated national savings and put it into treasuries. Well, what happens when they start to look at their own country and go, well, it was yielding basically nothing, 0.3%, but now it's yielding 3.2%. Maybe that's attractive. Maybe I want to get rid of my US treasuries, sell the dollar, buy the yen, then buy this 30-year JGB. Well, you would expect bond yields to come down, the value of the bond to start going up again, and therefore the yield to come down. You would expect a weakness in the dollar, right? Because first they sell the US Treasury, now they're left with dollars, got to sell the dollars to buy the yen. So you would expect weakness in the dollar, and it would put upward pressure on US Treasury rates. So this is why Scott Bessent, recently Treasury Secretary for the U.S., this is why Scott Bessent recently made a comment that kind of surprised a lot of people, where he said that the Japanese central bank should be hiking interest rates because if they allow Japanese rates to get too high, that will entice capital repatriation. That will entice the trillions of dollars that Japan has in US dollar denominated assets to be sold. And whether that's a headwind for equities like the S&P 500, NASDAQ, this is a theme we've been talking about going back to March and April, or real estate. Japanese own a lot of US real estate, or what really matters to Scott Bessent and the government, treasuries. If the Japanese start selling US treasuries to then sell dollars, to then buy yen, to then buy JGBs, number one, that would put upward pressure on US treasury rates. And we know from all the various videos, including the one yesterday on what a bear steepener is, we know that there is already upward pressure on rates here in the US when it comes to treasuries. Now, Great Britain is also in significant distress. Maybe it's time for an update on their debt crisis. They are in arguably a full-blown fiscal crisis right now. We can see that their 30-year yield is now at 5.6%. Again, eventually, the rate becomes too high. Great Britain actually has even longer maturities, and those are even yielding even higher rates. And so the fiscal crisis, we covered this, I think, a month ago, the UK fiscal crisis. Maybe it's time for an update. Their bond yields are continuing to surge to new all-time highs and looking like they're starting to get out of control. But again, remember with Japan, the story is not that their bond market is imploding, because you would see weakness in the yen if it was a crisis, a currency crisis, a fiscal crisis, a sovereign debt crisis. You would see weakness in the currency, but that's not what you're seeing. So some of this is healthy. Remember, higher bond yields are healthy if you have higher nominal growth. If your economy is finally starting to accelerate after 2 decades of very poor growth, you would expect higher bond yields. So it's not Japan is imploding and the bond market's imploding. The real story is, at what point do these yields get high enough that they start to entice all of that 75% positive NIP as a share of Japanese GDP? At what point do all those savings that are in U.S. treasuries, real estate, U.S. equities, at what point do the Japanese start to go, you know what? We've been in America, been in the dollar, been long the dollar, which, by the way, has not proved very effective over the past year. And, it's time to bring some of this money home. Japan is finally starting to heat up again. My own country, our own country is starting to finally do well. I'm going to bring that money home. I'm going to sell U.S. treasuries, sell my U.S. equities, sell my U.S. real estate, Then I have dollars. I will sell those dollars to buy the yen. And then I will buy JGBs or Japanese equities. That is really the story when we're looking at Japanese bond yields. That is really what really matters, not you just cursory look at the yield and going, oh well, it's up a lot, so Japan is imploding. That's not really the takeaway that I think is the most important. So, anyways, hopefully that was helpful. Also, of course, got to keep watching China to see if this reacceleration is really taking hold. I did hear an analyst, a Chinese analyst on the Chinese economy, saying that it was looking like China was starting to reaccelerate. This would be even more bullish for kind of global growth over the next 12 months or so. It does appear that US growth is starting to accelerate on a nominal basis, both inflation and real growth. So we'll continue to watch that. If you'd like to see an update for the UK or maybe France, leave a comment down below and maybe we can get to that. So, anyways, hopefully that was helpful and I will catch you in the next one.